Vikas Khemani from Edelweiss as well joins in on board. And Vikas, it's been panic selling out there. When do you think it's all going to stop?
It's $1 million question. I wish I had an answer, but I think actually we are passing through a crisis phase, and if you see, it's been led by currency, and every day we see currency deteriorating sharply. And this week in particular has been a very worst week. So I think this at least at that same time, government seems to be sort of ineffective and not able to control anything. So I think this is sort of further panicking institutional investors. I mean, in fact, last 1.5 weeks we have seen good amount of sort of selling flow coming in, especially in the large caps from the foreign institutional investors. So I think this is slightly worrisome. Now, how much, to what extent, one cannot answer that, because I think we are not seeing any sort of concrete measures to correct the current situations. Obviously, with the steep fall, there is always a self-correcting mechanism. Where will it find? I hope that it finds soon some sort of bottom. Rupee stabilizes somewhere around this range, and I think that will sort of lead to some amount of stabilization in the equity markets as well. But I think precondition would be some amount of stability towards the currency market, and I think everybody is looking towards RBI and government to sort of take some measures to sort of correct that situation. Currently, we are sort of not seeing any such things. So let's see how it goes, but definitely we are passing through a sort of a crisis of confidence at this point in time.
Vikas, do you think we have a long way to correct? Because based on Bloomberg consensus, Indian markets are still trading at P multiples of about 12-13 times, and 12-13 times in comparison to other emerging markets and based on historical averages is not cheap.
So Nikunj, you can always make whichever side of argument you want to make. Like, one can look at a 10-year chart and say Indian markets have historically traded or at a premium to the emerging markets. So I think it's not at this point in time strictly about valuation and particular number in mind. I think at this point in time, essentially it is about the current ongoing situation. And I don't think at this point in time anybody would be sort of preempting the fall and come to do bottom fishing. I think, and also given the kind of magnitude of the situation, complexity of the situation, no solution can be quick and fast. So I think one thing is becoming very clear, that once, even if the situation settles down, panic settles down, I think the recovery will be slow and will take long. So in that situation, I don't think anybody is sort of coming to do bottom fishing. And if that is the case, then putting a bottom number, putting that what kind of downside could be there from here is very difficult. If we remind 2008, I mean, we saw what kind of sharp cut. The situation was different, but I think again at this time you can say that it is sort of largely emerging markets are in one basket, and India specific has a different problem. So markets can sort of surprise both on the downside and upside, and I do feel that I think till the time you see some sort of concrete actions, sort of confidence building from the government side, from the RBI side, from the all quarters, I don't think there will be big sort of buying coming in the markets to stabilize. So putting any number is very difficult according to me.
Vikas, so what happens in such a scenario? Because clearly the finance minister has been trying to talk up both equities as well as currencies. That hasn't quite helped. Any measure by the RBI doesn't clearly seem to be working for the currency at all as well. What should be the right investor approach? I mean, I'm sure you must be getting frantic calls from your clients. What is it that you're telling them at this point?
So I think, again, depends on the kind of client you have. Unfortunately, government has been trying to talk up the market, and I'm at loss that, they don't know that, talking up will not help. Concrete actions only would help, and I think I don't understand why, still they are very quiet about increasing tariffs. I mean, that's probably one of the most obvious things to control the current account deficit, and I think there's no discussion happening around that, except some filler once in a while being sent. So I think people would be looking from talks to sort of action, and so far I think it's been only reduced to the talks. So hence I think markets are getting in further panic situation. And I think we've been saying for some time, and I think we continue to say that still I think you are best advised to keep as much as cash you can, be more defensive. I think sectors like IT, sectors like where, while it might turn out to be the consensus call, but still, IT could be a new consumer in that sense for some time to come, because I think rupee is unlikely to appreciate from here in a hurry. So I think you have to be defensive, you have to be sitting on cash in markets. Banking is a one sector which is creating lots of panic in the institutional investors and which continues to reel under pressure. And I do think that if the situation continues to be like this, you might see some more pressure coming on the banking sector. And I don't see an immediate solution in a hurry. So I think I do feel that there would be pressure. So idea is to sort of manage the risk of the portfolio as much as you can. Sit on cash. Cash would be the king. There would be an opportunity to buy once the environment settles down. Even if it is slightly sort of expensive from here, I would say that it's better to avoid that risk. And I mean, this is not a new stance. We've been saying that for some time. And I think we still feel that even at this levels of the market at this time also, I think makes sense to sort of manage the risk well than really looking for returns.
Okay, 200 points down approximately for the Sensex, 75 down for the Nifty, which means we've fallen about 250 points plus in 24 hours, and that's a very, very scary sell-off. And for a global investor, the sell-off is even scary because the currency also has lost out. The Nifty in the month of August now has taken a hit of about 14% plus. That's a very, very nasty fall. Because in the month of August, about $1 billion, approximately $1 billion of global liquidity has moved out, and Nifty has taken a knock of 8%. What if another $2-3 billion gets out?
I mean, Nikunj, the bad part of our markets is that we don't have depth, and at the same time, when everybody is looking to on the same side of the trade, markets fall without too much of the sort of volume or too much of the selling. So I think even if I mean it's very difficult to put in a number, but I think if I were to put the number what you mentioned, I think you could see a fairly sharp cut in the market if that kind of selling comes through, because I don't think there's any buying power in the domestic investors' hand who could come and absorb that kind of liquidity. So I think should the selling pressure continue from the foreign institutional side, I do think that you would see sharp correction in the market. No, not again because of valuation, but I think because of the liquidity and technical factors.
Because PSU banks have cracked below their book value. Large cap infra stocks have become penny stocks now. Metal stocks are trading at P multiples of 4 or 5. So what could correct? What could compress in a falling market?
I think what we have seen from the panic, like as you said, the stocks which have already corrected where probably exposure is less. I think in times like this, investors end up selling what they can sell, what is easy to sell, and what is expensive. So I think and that has been the trend also in the recent past. You've seen bankings getting sold. All of a sudden, you can sell an HDFC bank or ICICI bank even if at a lower price, but you can sell. So investors tend to sell what they can sell. So I think we have seen that selling coming through. We have seen some amount of consumer selling coming through, and which has sort of led to the market sort of fall, because you've seen now selling coming in heavyweights, and that is sort of pronouncing the fall. So in times like this, this is always the case. It is not, I think, at least based on the reaction what I have seen with the institutional investor in last 1.5 weeks, it is more, I think, how do you create cash, more how do you reduce risk than really stock specific. So in that sense, it is mostly top down. What you could sell, I think, gets sold.
Because what happens then to the outperforming end of the market, the likes of Select Pharma, or for that matter, the entire IT pack? Is it time to add positions over there, or do you think it's just a matter of time? We are going to see a bout of profit taking come into the IT pack as well, as was the case yesterday with blue chip stocks like HDFC as well as HDFC Bank.
See, again, I think IT is one sector. I do feel that probably it's very early to call that there will be profit booking or selling, because I think it just begun to sort of in the recent past started doing well. US markets are doing well, so that is the one case where valuations are not outrageously expensive. Rupee is helping, and I think US growth is going to help in terms of volume growth. So I think for them the business environment is improving. So all the matrices what you need for an IT company to do well is doing well. And secondly, all rest of the sectors are also under pressure. So in my opinion, you will see incrementally more and more sort of funds getting allocated towards IT sector, and I think valuations of the sector are not outrageously expensive. So I do feel that that is the one sector you will continue to see. Same is I think for pharma, that sector I think will continue to do well. Other sector which I think can probably do well or hold on would be metals, because I think falling currency helps, because most of the prices are linked to the dollar prices. So I think in that sense that sector can hold out, and I think if US or if the developed markets grow, there is a case which can be made in terms of strong or stable commodity prices. So I think these 2-3 sectors are sort of, in my opinion, likely to hold on, and I think institutional investors are sort of allocating more and more money towards this, because I think they cannot sit on full cash. I mean, they have to balance their portfolio in terms of underweight and overweight.
Because do you think something like a Reliance is a blind buy at current level? A, they are big exporters. B, the gas prices from 2014 is poised to go higher. The gas prices is denominated in dollar terms, and because rupee has gone down against the dollar, the net realization for Reliance will only improve.
Yes, I think we've been very positive on the stock per se for some time, and I think the recent correction only sort of helps the argument. And as you mentioned, most of the factors, I think the gas prices are improving, realization is improving, and I think also petchem cycle is also sort of likely to fall in place, and we expect the margins to improve on the petchem side. So I think and there's a if you look at slightly longer term, there's a capacity expansion also happening. So I think, and lastly, it's underweight the position most of the portfolio managers portfolio. So I think this stock would do well, and I think also sort of help in some sense a defensive buy in the portfolio. So we are seeing some sort of flow coming through in the stock, and the stock also doesn't fall in line with the markets.
Because what about banks in particular? I mean, is it a right time to start nibbling in, because the valuations sure look mouth-watering for some of these names?
I think looking at valuation in current environment at this point in time, I would say probably not. I would not preempt buying in any of the sectors where there are problems. If the current situation continues, I would reiterate the NPA situation will become very big, will get more and more deteriorate from here. And also I think as this quarter number will be more important, as the yields have risen, there would be losses on the security portfolio. So I think I do feel that if an environment continues like this, you will see NPA issue becoming bigger, and nobody would sort of come ahead and take big position in these banking names. So I would really look to, rather than in a particular looking at a particular level, I would look to sort of see how things are panning out. Is there a change expected soon? That would be the better time, because I think we have seen historically same banks have traded even 0.3 time book. So at 0.6 also it is below book, 0.7 also is below book, at 0.3 also below book. So I think unless the macro environment improves, and which has not improved, and it looks like it will be at this point in time, at least next 6 to 8 months doesn't look to be a great time. So I think I would not probably preempt anything. Having said that, there could always be temporary rally, bounce back rallies. I'm not making a comment on them, but I do feel that from a fundamental perspective, I would want to, or I would advise investors to wait and watch, especially in case of PSU banks. Definitely banks like SDFC, where asset quality issues are not great, bank like ING Vaishya, where asset quality issues are fairly controlled. I think you could look at the argument you made that at a particular valuation you could always sort of make your entry in. But otherwise, I would strongly avoid all the public sector banks and the banks where there are asset quality issues which could get pronounced.
Vikas, good having you on the show. Appreciate you taking the time out and speaking with us. That's the view coming in from Vikas Khemani from Edelweiss.